2015 quiz. So I've done this in screenshots so that I can mark on it versus doing it actually in mybusinesscourse.com. You can fast forward if you're just interested in specific questions, but I'm going to go through each 1 through 9. So this first one, this is around deferred revenue. Scenic Airways collected $415 in cash. The customer purchased a one-way ticket on October 1st for a flight that they'll take on December 15th. The first thing to remember here is that on October 1st, we may have received cash, but we have not earned any revenue yet. So on October 1st, right, 10-1, we'll debit cash. We don't credit revenue. Instead, we credit deferred revenue, which is a liability. When they actually come in and take the flight on December 15th, we will take out that deferred revenue. Again, 415, and we can finally credit service revenue or sales revenue. All right, next one. Let me get out of this picture. Done. All right, next one. Now we're on question 2. So let me get ready to be able to edit that one. And for question 2, the company issued a 9-month, 8% payable note. Never let the term of the note confuse you. The rate you're going to get is always expressed in annual terms. That's just the way we express interest rates, regardless of whether you're in accounting class or finance class. If you're not told anything differently, you can always assume a rate is an annual rate. So first thing, record the issuance of the note payable. Hopefully that one came pretty easily. We debit cash, $900,000, and we credit the note payable, $900,000. All right, when it comes to December 31st, we haven't paid the interest yet because it tells us the interest will be due at maturity. However, we still need to record it because every day that passes, we owe interest. So to get that interest amount, I'm going to do $900,000 times that 8%. Sorry, it's so messy. And I'm going to do that on my calculator right here. And that's $72,000. I'm going to go ahead and divide that by 12 so that I know the monthly amount, and the monthly amount is $6,000. So remember, we issued that note October 1st or October 31st. We're at December 31st. That's November, December. So this is just 2 months because see, we didn't issue it until October 31. So that means we're just going to accrue interest for 2 months. So we will debit interest expense and credit interest payable for $12,000 because that's 2 months interest. Now fast forward to July 31st. The full 9 months has passed and it's time for us to pay the note back. So we've got a couple different pieces. The first piece that should come pretty easily to use, we've got to take that note payable off the financial statement. So I'm going to debit the note payable, $900,000. I also need to record interest, but I'm only recording interest from January 1st of the current year to July 31st, which is 7 months. Now we know this was a 9-month note. We did 2 months of interest back here at year end, so it makes sense we'd have 7 months of interest in the current year when we pay this off. So 7 months times the $6,000 is going to be $42,000 in interest expense. But I'm not done yet. I need to clear off that interest payable because I'm getting ready to pay it back. So I'll just look back to this previous entry, take off that interest payable. And then lastly, I need to give them the cash. And I'm giving them cash of the $900,000 plus 9 months interest. So that's $954,000. So those are good to practice. They should come relatively easy, but those are a good practice problem. All right, number 3. Here we're trying to decide whether something should be classified a current or a non-current liability. So remember, that with this type of question, we're not doing any journal entries. We're just looking at our financial statement and saying, based on the information we have before we file our financials, right? So if your financials are as of December 31st, right? December 31st. If you don't file your financials until, let's use the example in this problem, I think that there's one in here where they issue their financials March 15th, which is fairly typical. During this whole time frame, I've got to still be analyzing what's happening and deciding how to classify it. Because even though it's as of December 31st, I can use information from that time period until I file. So first one, $100,000 10-year note payable originating September 30th of year one. Okay, so we're in year one. The note's going to, let's see here, let's ground ourselves in the time frame. We're talking about our year 10 reporting. So if I issued a 10-year note on year one, when I get to year 10, well, now it's due within a year, so I would put that into the current liability. Second one, a $200,000 5-year 7% note payable was originated year 9. Okay, well, if I pause there and I don't read anything else, I would think, okay, well, it's year 9. I'm reporting as of year 10. That means this loan's still got roughly 3 more years outstanding. It should be non-current. However, let me keep reading. The person that lent us the money has the right to demand immediate payment if we fall short of the required ratio for longer than 3 months. Oh dear. Okay, let's look and see what our ratio is at our reporting date. Oh, it's fallen below 2. So immediately you would say, all right, we're going to have to push this into current because we failed the ratio. However, there's one more piece of data. By March 15th of year 11, which is the issue date of the financial statements, we have cured it because the ratio is back up to 2.05. And we had a couple months, right? We had 3 months that we could cure it. So because we've cured it, because it's not due for several more years, we can keep that as non-current. The last one, we took $160,000 of bonds payable due on March 1st of year 11th. Oh, okay, well that sounds like it should be current. However, before our issue date, right, in early January, we issued stock and we paid off the bonds. It's giving us this additional information about cash, so just to prove to us that, yes, the cash was used to pay off the bonds and not for operating purposes. Because we took either long-term assets or common stock and paid off the debt, we can keep that in non-current. So remember, in this time frame, again, sometimes CFOs are making choices because they want to represent their liabilities. Usually they want to push things as far to non-current as possible, so they might be making choices there. All right, let's move to the next one. Problem 4. This is the one that NBC.com has the flat out wrong answer for one of them that you guys need to get credit for. All right, so remember, there's 2 types of warranties. We can have a service warranty or assurance warranty. All right, assurance warranties, those are included in the price. So if you walked into Apple and you walked out with a phone and the phone broke an hour later, well, Apple's going to fix that for you. That, it comes with a certain level of warranty. That's an assurance warranty. If you bought AppleCare, right, you're going to pay extra for that, and that is a service warranty, right? So that has a standalone price. It's not included in the price. And we're going to account for these differently, because if it's an assurance warranty, I don't accrue a liability. I just expense as I pay bills, right? So expense as paid. Whereas with the service warranty, I need to do some type of accrual because I want to record some revenue. All right, so let's take a look at this. Gatsby Company introduced a new product carrying a 2-year warranty against defects. Okay, so the product comes with a warranty. The estimated costs are 2% of sales in the first 12 months and 4% in the second 12 months. A lot of students say, well, why would I go ahead and estimate the warranty at the full 6%? Well, you estimate the warranty at the full 6% because we're earning revenue for selling the product right now. And we know whether it's this year or next year, we're going to have expense in roughly 6% of that revenue number. So when it comes to the amount of warranty revenue, we're going to take that $360,000 times the 6%, and sorry, I'm not doing warranty revenue, I'm doing expense, and that's going to be $21,600. I don't have any revenue because I didn't sell this separately. It's part of the price. In the next one, we're assuming it actually has a separate price. So now it's a service warranty. This was assurance, right? Assurance, we need a liability. For service, we don't. We just expense as it happens, but we do get to record some revenue. So now assume it had a separate selling price. So that $10,800, we can't record that as revenue all in year one because the warranty is for 2 years. So we're going to only do half of that. And half of that is $5,400. That's where NBC or mybusinesscourse.com has an incorrect answer. For the warranty expense, we're just going to look at however much we spent. That's also $5,400. Weird coincidence. I think that's probably what messed them up. All right, let's move on to the next one. Number 5. Here we're looking at, if you think about Chapter 15, you need to know a lot about contingencies and whether or not you need to record or report the contingencies. So in this one, a company issued $750,000 of bonds payable at par on January 31st of year 2. You may remember we had to think about events as type 1 or type 2. Type 1 we record, type 2 we disclose. We would disclose this. So no impact to revenue or expense. Second one, the attorney for the company believes it's highly probable that the company will win a court settlement in the amount of $450,000 expected to be settled the second quarter. Well, okay, you can see I can estimate it and it's probable. However, the reason we don't record anything is because it says win. We never record potential gains. If we were going to settle a lawsuit where we were the ones paying and it was probable and we could estimate it, then we would record something. The next one, we've got some friend or vendor that we have said, okay, if you don't pay your loan off, we'll pay it off for you. We've guaranteed the loan. The bank, whoever this bank was, they required the guarantor. The bank indicated that the probability of default by the supplier was reasonably possible. All right, so again, we go to that word reasonably possible. We only record expenses if it's probable and estimable. That's why there's nothing recorded there. Lastly, the company was sued for $900,000 in damages due to a product failure. Legal is of the opinion that's probable. Okay, there's that word. That the plaintiff will prevail and the company will have to pay 10%. So we can estimate it. So 10% of $90,000 means we're going to have 10% of $900,000 means we're going to have a $90,000 expense that year. Okay. Next one, question 6. Pine Company borrows $400,000 cash by issuing a note payable to National Bank in the amount of $400,000 bearing 8% interest with interest payable at maturity. It is December 31st, so we need to figure out what to record. Remember, we're going to go between September 1st, December 31st. That is September, October, November, December. That's 4 months. So that's how much interest payable I should have. And if we do the math on that, I take 400,000 times the 8%. That's 32,000. If I divide that by 12 to get a monthly number, that's roughly 2,667 times 4 months gives me 10,667. So the correct answer is C, because I'll have that interest payable. Number 7, this is one I gave everybody credit for. So in general, the correct answer here is letter G. And letter G tells you that it's just C, which is an obligation to transfer assets or provide services, must be unavoidable, that the existence of the obligation is at least probable, right? So that word probable is what makes C correct. The word assured is what makes A incorrect, right? Because it only has to be probable that we have to provide something. It doesn't have to be assured. I gave everybody credit for this because I just felt like that was getting too nitpicky. Number 8, okay, on this one, we are working with gift cards. So we've got non-refundable gift cards sold in 2020, and we had some gift card redemptions. Here you're doing that proportional method. So you say, well, if I sold, let me get my pen going. All right, so I sold 25,500 in gift cards, right? I think that 90% of those will be redeemed. I think that 10% will never be redeemed. And 10% of that number is 2,550. So the question we're trying to figure out is, can we record that whole 2,550, right, into our revenue right now? Well, the answer is we can't. We've got to look at the proportionate share to the amount that I thought will get redeemed, which is the 22,950. That's 90% of the 25,500, right? So I think 22,950 won't get redeemed. 22,950 will get redeemed. I've had 18,360 get redeemed. That's roughly 80% have been redeemed. So I can take 80% of this number now. 80% of that number tells me that I believe on mine it's 2040. It might be a different letter on yours. Okay, last one. This is around what's a liability? So if an employer's obligation relating to employee rights to receive compensation for future absences is attributable to services already rendered, if the payment of compensation is probable, there's that word again, and can be reasonably estimated, there's that word again, we know we need to accrue the liability. However, we're only going to accrue the liability if it vests, right? For mine, that's letter A. It might be different on yours. Vest or accumulate means that it truly is owed to the employee. Like where my son works, his vacation doesn't carry over, right? So they don't need to accrue anything. Most companies where you work, your vacation carries over. So if it's probable, we can estimate it. We definitely owe it to the company. It deserves an accrual. So